Welcome back. Today we're diving into a company that just hit an absolute record-breaking milestone. Imagine a business that actually collects cash from its customers a full 100 days before it has to pay its own suppliers. Pretty wild, right? Now combine that incredible cash-generating machine with a record financial year in 2026, revenues surging to 1,646 crore rupees and profits hitting entirely new highs. Today, we're bringing our clear, stress-free investing approach to India's second-largest diagnostics chain, Metropolis Healthcare. We are going to break down their aggressive new growth strategy, pop the hood on their financials, and figure out the exact valuations the market is pricing in right now. Now, before we really get into the weeds, let's lay down our responsible foundation. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, here is our roadmap for today's explainer, just so you know exactly where we're heading. First, we'll go inside the Metropolis 3.0 strategy. Then we'll check out their fortress financials and cash. Third, we'll run through the forensics and quant scorecards. Fourth, we'll map out valuation scenarios and give our final verdict. And finally, subscribe and next steps. Let's kick things off with part 1, inside the Metropolis 3.0 strategy. You see, Metropolis is not just running your routine, everyday blood tests anymore. They're executing what management calls Metropolis 3.0. It's basically a 3-pillar strategy aimed at pushing the company way up the value chain. They are doubling down on core direct-to-consumer and business-to-business growth, aggressively scaling adjacent fields, and using targeted regional M&A to expand their map. And their move into precision medicine perfectly illustrates this. In January 2026, they launched a dedicated Center of Genomics. Genomic diagnostics is a massive $4 billion global market. More importantly, these specialty tests command anywhere from 2 to 5 times the revenue of a normal routine test. It is a huge leap in profitability. What's genuinely fascinating here is the powerful dual-engine growth they've got going on. If we break down the revenue mix, their core B2C, the walk-in patient channel, makes up 65% of their revenue. But the B2B channel, which represents hospital outsourcing, sits at a solid 25%. And in the fourth quarter of 2026, both of these engines fired at the exact same time. Direct B2C grew at 20%, while hospital outsourcing surged by a massive 28%. Finding a business where institutional volume and consumer premium growth are accelerating together, that's incredibly rare. To fuel this kind of expansion, Metropolis has been super busy acquiring strategic regional labs. They spent 247 crore rupees to snap up Crore Diagnostics, which instantly handed them an oncology focus and a massive foothold in the Delhi NCR region. They've also scooped up Dopic for an entry into Uttarakhand, Scientific Pathology for a UP foothold, and Ambika Pathology to expand deeper into Tier 2 cities in Maharashtra. Historically, Metropolis was really heavily reliant on West India, but these targeted acquisitions are successfully de-risking that geographic concentration and letting them spread like wildfire into entirely new, high-growth markets. Okay, let's move on to part 2, fortress financials and cash. So the real test of any strategy is proving the thesis with hard numbers, right? And financial year 2026 was an absolute inflection point for them. Look at the recovery from FY25 to FY26. Total revenue jumped from 1,331 crores to 1,646 crores. Profit after tax climbed a very healthy 31% to 190 crores. But here is the absolutely crucial part. Their organic revenue grew 13.7%. That actually beat management's own guidance. It proves that this phenomenal growth isn't just some artificial acquisition-driven bump. The underlying core business is fundamentally accelerating. And then we have this number, -103. Honestly, this is the holy grail of financial moats. It represents their cash conversion cycle in days. Let's put that into perspective. A negative 103-day cash conversion cycle means Metropolis collects cash from its patients right at the point of service, over 100 days before it actually has to pay its own suppliers. They are essentially running and growing their entire business using their suppliers' capital. This dynamic turns Metropolis into a totally self-funding machine. In FY25 alone, they generated 275 crore rupees in operating cash flow, all while keeping a completely debt-free balance sheet. They literally have the financial firepower to execute endless M&A without taking on a single rupee of leverage risk. And that financial firepower builds some incredible stability in their ownership structure. Over the past year, foreign institutional investors have been slowly trickling out, dropping from 12.8% to 11.6%. But the domestic institutional investors, the smart domestic money, specifically 9 major mutual funds, has aggressively scooped up those shares, pushing DII ownership from 27.2% all the way up to 30.4%. When you have a massive 49% committed promoter stake with almost zero pledging, paired with top-tier mutual funds holding 30%, the stock gains incredible stability. The weak hands are out, and the long-term capital is firmly in.
Let's jump to Part 3, Forensics and Quant Scorecards. Time for a quick health check.
We ran 3 rigorous quantitative models to test their earnings quality and financial stability. And guys, Metropolis delivers a rare, perfect trifecta here. A maximum 9 out of 9 on the Piotrowski F-score confirms absolute fundamental strength. An Altman Z-score of 10.03 is way above the 2.99 safety threshold, meaning bankruptcy risk is virtually non-existent. And a Benish M-score of negative 2.81 easily clears our threshold to prove that their earnings are incredibly clean and unmanipulated. The cash they generate exceeds net income substantially here. But hey, we always want to be transparent and look for any cracks. We did find a few minor watch flags. There's an ongoing 38.8 crore income tax demand that the company has already appealed. They also recently rotated their auditor to Deloitte, but that's just a standard regulatory 5-year rotation, not a red flag. They took a 9 crore exceptional charge for a labor code implementation in Q3. And finally, their 3-year profit growth was technically negative at minus 1.2% before this huge FY26 inflection, mostly due to post-COVID normalization. The big takeaway here, management has been highly proactive and honest in disclosing all of this. The actual forensic risk here is extremely low. Which brings us to Part 4, Valuation Scenarios and Verdict. How do we actually price this growth? As of late May 2026, the current market price sits around 550 rupees. Now, it's absolutely crucial to note this is after a 3-1 bonus issue they completed back in March. So if you just glance at the raw price-to-earnings ratio, 56x admittedly looks pretty expensive. However, when you switch gears and look at the enterprise value to EBITDA ratio, it sits at 26x, and it's compressing rapidly. The reason for that? That massive operational leverage we talked about earlier. And this brilliantly illustrates exactly why the market is perfectly happy paying a premium today. Just look at the margin expansion trajectory. In FY25, EBITDA margins were 20.5%. In FY26, they bounced up to 24.4%, and management is confidently guiding for a sustained 27% to 28% margin over the next 3 years. The market is pricing in a massive 350 basis point margin expansion as their specialty tests and acquisitions fully integrate into the core business. So to make sense of this, we modeled out 3 distinct scenarios for the next 12 to 18 months. If margins stall out at 22% and integration fails, our bear case points to 430 rupees, which is about a 22% downside. Our base case assumes a very reasonable 14% growth with 26.5% margins, giving us a target of 620 rupees, or a 13% upside. And if management executes perfectly and hits that 28% margin, our bull case target is 780 rupees, a massive 42% upside. The reality is, current prices require near-perfect execution, so any quarterly earnings miss can actually create a temporary dip, offering a much better entry point. Bringing all of this data together, Metropolis earns a final stress-free scorecard rating of 68 out of 100. It's a high-quality, solid B-plus grade business with very manageable risks. Our official verdict is to accumulate. But ideally, you want to be patient here. Look to add on dips in the 470 to 500 rupee range to ensure you're getting an optimal margin of safety. Finally, Part 5, Subscribe and Next Steps. Will this aggressive push into precision medicine make Metropolis the undisputed king of Indian diagnostics, or will hospital competitors catch up? Only time will tell. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.